Welcome everyone to this week's speaker series. I'm happy to be joined today by Dana Burns. Dana reaching us from Pinebridge. Dana, thank you for coming.
Thank you for having me. Absolutely.
Yeah. So Dana is a senior portfolio manager on the team. He focuses on investment grade fixed income. So it's been a quiet year for you. Obviously not a lot of volatility in your space. Obviously joking there. Dana, talk to us about, you've been a manager for a while. I know you've been at Pinebridge, I think since 2007, and you were at several banks before. You clearly have never seen an environment like the one we've had this year. The backup in rates has been quite sharp. How were you guys positioned this year to start, and sort of what did you anticipate or not from the central bank going into the year?
Sure. Yeah. So again, well, thank you for having me. Yeah, coming into this year, and really actually starting last summer, when the Fed made its intentions known that it would be tightening monetary policy, we actually embarked on a de-risking strategy in the portfolio. And granted, it was gradual through last year, but as we entered this year, we were more defensively positioned. I would say, if you're looking from a beta standpoint, last summer we may have been 1.25. Today we're probably closer to flat the index in terms of that risk, but certainly more defensively postured. Now, what's been so interesting this time around is that the Fed is actually fighting something. The last couple times they've raised rates, it's in prior times it's to slow down growth, and what they've said is we're gonna watch the data. And typically, investment grade credit will languish. You'll lose support at the long end. People aren't interested in having more duration. This time, they're fighting inflation. They've made it very clear, and they really allowed rates to push up dramatically. So I would say that we're probably a little bit surprised by the speed in which it happened. It seems to be happening very quickly. So you had people were initially afraid of duration really for the first 3 months of this year, but then as rates moved up so rapidly, and frankly the price of long corporate credit came back down, people were actually comfortable buying at the long end because it was so clear what was going on, and because rates moved so quickly. And that's really what's so different now. There's the speed with which rates have backed up this year.
Right. And I'd like to remind everyone that you can submit your questions to us via the chat or to me directly. I'd be happy to share them with Dana after a few brief minutes where we have a conversation. So Dana, when we started the year, the market was not expecting the Fed to raise rates until 2024. Then that quickly shifted, the pendulum swung the other way. At one point, I think the Fed funds futures got to around 3.8 or so. This was back in June. They've now swung a little bit further to the left again. Now, at this point, the market's expecting the Fed funds rate to be around 3.4 by the end of the year. What's your view on that? And some Fed officials, by the way, have come out recently and said that that sounds about right. So, in your view, and perhaps with how you're positioned, do you think the Fed will get there, it will fall short, or that will it have to raise rates beyond that?
Yeah, so I think that right now, if you look at the futures, they're pricing, it's pretty much a 50-50 jump ball, whether they go 50 or 75 at the next meeting. I think getting out to 3.25 is certainly in the cards, and then I think they're kind of see what's happening. We are seeing some of these inflationary pressures abating, so I think they want to see what happens as these changes work through the system. But what's really important, and we're always focused on rates, but it's the quantitative tightening, right? It's the reduction of the balance sheets, right? So they announced, or they're actually in the process of reducing treasuries at the 30 billion a month, mortgage-backed securities at 17.5 billion, and that will double next month, right? So that really has a very big impact on liquidity in the system. So when you have quantitative easing, if I give you $1, you might spend 60 cents of it. You might save 40 cents of it. So the impact, yes, it puts liquidity in the system and helps support asset prices, what have you. But when you remove that, I'm just taking that full dollar from you. Okay, that's a kind of a simple way to look at it. But with that liquidity coming out of the system, that has a really big impact on risk assets. It has a big impact on growth, not only in the US, but abroad. And so as that starts to have an impact this year, we think that it's going to lead to contribute to a slowing of economic conditions. So it's not just where we're going to end up in terms of the Fed ultimately, but also what's going on in terms of quantitative tightening. Now, beyond this year, you could see the Fed actually have to cut rates, or at least signal that they're done. And when we get that pivot for us, that's the time we're probably going to be adding risk, because then we're going to have more supportive monetary policy.
So from a portfolio perspective, your team is waiting to get an actual signal from the Fed that they're either pausing or done raising rates in order to extend duration.
Well, I wouldn't say so. In terms of duration, our approach is actually we don't take huge bets in terms of duration.
Okay.
Typically plus or minus half a year. We believe that getting the interest rate call right consistently is difficult. So we like to focus on what we do believe is repeatable, and that's security selection.
Okay.
Nonetheless, we're pretty close to home in terms of duration, but in terms of the composition of the portfolio, we're about 6% in treasuries, about 3% in cash, but then we have some high quality paper at the front end of the curve, with the idea being that we want to be liquid. We want to have that dry powder. So ultimately, when the Fed, it appears that the economic data is supportive of a Fed that can pause, or they even indicate that they may have to pivot fully, we're going to be able to move into the credits we think are going to perform in that environment. Typically, right, in a rising rate environment, you typically want to have more exposure to financials because they're going to do better. At a point where the Fed's pivoting and becoming more supportive, we would then move into industrials, which would do better with a more supportive Fed.
Okay, so from what I gathered, your approach is mostly duration neutral. You don't deviate much from the benchmark there in terms of duration. So where you're trying to find value is on the credit side. So maybe for our listeners, how do you go about that? How does that process work? How do you find opportunities in the credit stories of some of the names in your universe?
Sure. Well, obviously, we have a dedicated team of analysts. We have a number of formalized meetings. We have a proprietary system by which we rank the credits within a sector. And also, we do have an internal ratings scheme as well. I mean, if there's one thing we learned coming out of the financial crisis, it's that rating agencies tend to be lagging indicators. So we want to you have to pay attention to what they're doing, but you want to be independent in your credit analysis. But through our formalized processes, our analysts will give us their views on particular sectors. And then through the meetings, we come up with the actual bonds that we wish to purchase. And so we call it integrated portfolio management. And what that means is we have the traders, PMs, and analysts in all those meetings, because an analyst may have that idea, but then through the discussions with the trader, we can figure out where's the best place to source it. Is it liquid? What part of the curve do you want to participate on? So I would say, right now, even though we're defensively postured, we have a number of bonds that we would call our story names. So these are situations where you're seeing a delevering situation. Typically, that's that we're looking to see in terms of improving credit stories within our space. And we still, in response to the pandemic, we saw a flood of non-frequent issuers into our market. And so there were a lot of opportunities in new names that came at very attractive levels. A lot of those names, reached fair value, but some still offer an attractive opportunity. Obviously, spreads have widened out here this year. We like to look at the option adjusted spread of the Bloomberg Barclays Credit Index. Again, that's just your spread above treasuries. That opened at 87 basis points this year. It got out to 150 basis points, and today it's back down to 132. So certainly more attractive in terms of spread. In terms of yield, it's almost 200 basis points higher on the index. So there are certainly some attractive opportunities out there. But as things are slowing down here. There are certain segments of the market that we have been reducing exposure into. That would be maybe like the energy space. We all know oil was very high. It's now down around 90. Typically, in a I wouldn't say we're technically in a recession. It doesn't quite feel like it, but in a environment where the Fed is being aggressive and you expect economic growth to slow down, energy would be an area that you would not want, want to be underweight. We had maintained a slight overweight given some of the supply constraints, given the very unfortunate situation between Russia and the Ukraine. So we have maintained, so we've been reducing, that's one area we've been reducing a bit, and also in the basic sector as we have seen broadly commodity prices coming down. So it's a very credit intensive process. My predecessor firm, which is what Pinebridge was born out of, was one of the largest credit shops in the world when we were there. So we pride ourselves on our independent credit work.
Right. So you mentioned you've been reducing risk in energy, some also in the commodity complex. What are some of the areas in investment grade space that you still find that are attractive once you do hear the Fed, let's say, do that pivot that you expect them to do at some point?
Yeah, so you would expect it to be in broad industrial. So you would think you actually would think the basic space would do well. Capital goods would do well, broadly speaking. And we would also be looking to, in that instance, not only in those sectors, but moving further out along the curve. And as I mentioned, banking has been really thematically an overweight in the fund since the financial crisis, given the fact that there's more regulation, which, if you're an equity investor, maybe not as good of a story, but from a fixed income standpoint, that's okay. I win by getting par back ultimately. So a little less, better risk profile from the banks is fine. So we would be reducing banks, but then you would go into things like building materials, construction, that sort of thing. Those are the areas that are certainly going to be poised to do better should post Fed pivot.
Right. Okay, so let's maybe discuss a few sort of key metrics of the fund that you manage before we jump into questions from the general audience. So give us some key metrics, your benchmark, your regional exposure.
Sure.
Any kind of sort of constraints you have in terms of the different IG spaces, things of that nature.
Right. So as I mentioned, it's plus or minus half a year in terms of duration. One other unique thing to our approach is that we also constrain ourselves on the credit risk side. So that's index plus 15% in terms of triple Bs, because what we find is that when we look at our competitors, oftentimes people will blow themselves up if it's a good credit environment. Some of our competitors may have 90% triple Bs. They may incorporate high yield. We really try and stay true to what we are, which is managing IG credit in a very risk-controlled fashion. We do allow 5% in double Bs. That's historically not a major driver of alpha. What that really allows us to do is capture rising stars that are moving out of the high yield space, as well as to maybe hold on to a name that's briefly moving down at the high yield, and we would still expect it to recover in short order. There were a few names. One of them is a very well-known auto manufacturer here in the U.S. that moved down to double B plus right at the outset of COVID. It was downgraded. We had anticipated it would be back to IG this year. Given that things are slowing down, it's probably going to be, maybe early first half of next year. But it just allows us to hang on to it there. So something that sets us apart is certainly our approach in that we constrain duration and we do constrain our credit risk. And so, our rankings are quite good. I would say the composition of who's around us depends on what's going on in the market, but we're quite constant there. Looking at the yield of the portfolio right now, it's probably around 4.7%. The Bloomberg Barclays Credit Index, which is who we're benched against, the yield right there is around 4.3%. As I mentioned before, our beta versus the index is only slightly above it right now. We are more defensively postured right now, given that we do expect to see some continued volatility in the market. Nevertheless, as opportunities present themselves, we are going to look to take advantage of them. And then, I would just say it's a very well diversified portfolio. Close to 200 names in it. In terms of regions, predominantly domiciled in the U.S. We do have, a lot of companies are multinational, and some that used to be based here and are domiciled in other parts of the world. But what's very interesting about our market is that about 30% of the issuers in our market these days are non-U.S. issuers, and so the market is certainly global in nature. At Pinebridge, we're very lucky to have a large global footprint that allows, if there's an issuer in another part of the world, I'm going to get a phone call or an email on a credit view. So that's in terms of the constituents. That's something that's you kind of changed a bit in the market over the past few years. But by and large, this is it's a cash bond portfolio. There are no derivatives. And the other thing I would highlight is that given that we're more of I wouldn't call us, we're more of a boutique manager. We're not the 400-pound gorilla in the room. It allows us to be very nimble in our management approach. And to that end, what I'm saying is we can more easily establish meaningful positions in the portfolio because we don't need as many bonds as the other large managers. And on the way out, if you're finding yourselves in a difficult credit situation, if you're only selling, 50 million as opposed to, $1 billion, you're going to have an easier time. And if there's one thing we know that's happening right now is that liquidity is impaired. So being a more nimble manager is also advantageous right now.
And you're focused exclusively on dollar-denominated hard currency, right?
Correct. Yes.
Okay. All right, so we have some questions that have come in, so I'll use the last 10 minutes. We have one that came directly to us here. It says, fund is almost 14.4 down this first half of the year, which is better than the equivalent iShares Corp UCITS ETF, which is 16 down. Are these large drawdowns basically duration cause? What's ahead?
Right. Okay. So I just pulled up the Bloomberg Barclays Credit Index. So if you're looking at it, a lot of it is going to be caused by the rate move. Okay. So if the Bloomberg Barclays Credit Index is down, unofficially here, let's say it's down 11%. Excess returns, which is really the credit component, is only down 2.3%. So it's largely been a duration move, but it certainly hasn't been one way in terms of the returns what we're seeing here. Actually, July was the best month of the year for IG credit with almost 3% returns. But what's unique about this environment right now are the technicals. And the technicals that we're seeing here are non-typical buyers coming in, and that's sort of pushing things around a little bit. We've got private equity coming, I should say hedge funds coming into the space, high yield investors coming into the space, because a lot of the long bonds are trading at 65 cents on the dollar now. So they're coming in that maybe they're levered a few times. They know that at 65 cents on the dollar, these bonds aren't going to be called. They're going to be able to lock in that yield for a long time. So, but by and large, the returns are driven by the rates move. But I think that in terms of rates, I was thinking, obviously the 10-year hit 3.5% earlier this year. I still like the 250 to 275 on the 10-year in here. So if we do see any weakness here, I think it's likely to be driven on the credit side, but I don't expect a major blowout in terms of credit spreads.
Okay. I have a question here in terms of are you doing anything to hedge inflation risks in the portfolio?
No. We don't invest in tips or anything like that in the portfolio. We're of the mind that inflation pressures will abate. They were not transitory as many thought at the beginning of the year, but you are starting to see some of that weakness in the market. And obviously, when prices really go up very high, that can also just lead to a slowing of economic spending in general, and then slowing of economic growth. So no, so we're not hedging in terms of inflation, but we're certainly aware of what's going on. We're watching it very closely because that's what the Fed is fighting. We don't have an employment issue right now. It's purely inflation, and so that's the risk really is that the Fed pushes too hard here in terms of raising rates and tightening financial conditions. But as I said, we think that as we get into the first half of, really later this year, into the first half of next year, inflationary pressures will be heading in the right direction.
But another question here on how important is ESG in bond selection? Or do you have ESG considerations, I guess?
So with Pinebridge, you get ESG whether or not you want it. We've been fully integrated since 2000, for about the last 7 years. Everything that falls under ES or G, things like wastewater management, decisions that are made in terms of being closed loop with energy, product launching, product retirement, employee safety, all of these things have always had an economic impact on companies, has a financial impact on companies rather. And so we are certainly paying attention to it. It is part of our process. And honestly, it makes our analysts better. You're asking a slightly different question, but these are really what we would call, 21st century credit risks. And so we do pay attention to it. We have seen quite an increase in terms of green bond issuance or sustainable bond issuance. We've built to that, and we've built some very strong relationships with those syndicate desks, because often they're run in parallel with the existing syndicate desks. So we do pay attention to them. At various points in time, about maybe somewhere between 7-10% of the portfolio is actually in green bonds at any given time. So it is it's part of our process, and we are integrated.
Okay, there have been some, and let me piggyback off that a bit. There have been some concerns recently with the ESG designation. Basically, people have been overusing it. Investors are paying up for it, and they're not really getting it, right? Sort of like with the old organic labels. How do you mitigate that risk in your selection process? Certainly.
So obviously, it starts with the analysts, right? They're the first line in having these meetings. We have in our internal process, we have what are called key risk indicators that are based on SASB principles. So we're doing our own work. But when a new deal comes, depending on what it's linked to in terms of sustainability metrics, depending on what the proceeds of the deals are going for, we're paying particular attention. But I would say, with us, it doesn't impact our fees. As I said, you get it whether you want it or not. But I think some of our competitors have tried to create just separate products. We don't really subscribe to that. At this point in time. So it's as I said, it's embedded in our process. But you do really have to ask the questions. But what's really nice now, being that we're in IG, there's a lot of transparency in terms of ESG. Other maybe EM or high yield, they're getting better certainly, and they're on the right path. But in our normal quarterly filings, we're getting ESG data now, and they have dedicated communications people at these firms or investing in that will actually just speak to our analysts on ESG. So a lot more transparency on ESG when it comes to the investment grade market.
Do you have minimums, maximums of green bonds, let's say, of green bond issuance within your portfolios right now?
No, like I said, I don't know the exact number. It's probably between 7 and 10%. There's just the reality is there's just been a lot more issuance in the space, and there have been some opportunities. And I would say that the demand is certainly there, right? A lot of funds, there's some that only want ESG issues. So from a technical standpoint, demand is quite good. But if for some reason a bond that's a green bond, trades through fair value, and we think that it's not warranted, we're going to reduce our position size in a given name.
Okay. Let's take a bit of a step away from the United States. Let's look at some other regions of the world. Are you taking on or avoiding risk in any of the other major economic blocs like Japan, China, Europe?
So in LATAM, we do have a little bit. We have some utility exposure. We have a little bit of sovereign exposure. Where we're probably have reduced the most risk has been in Europe, and that has really everything to do with the situation in Ukraine. We also, I'm sure you saw, the Bank of England today. This was actually very interesting, saying, all right, we're definitely going into recession in the next 12 months, and we're raising rates. You would never hear that out of the Fed. But Europe is clearly heading into a recession. The inflation is quite high. There's an energy issue that we're all aware of. So to that end, and this is really started a while back for us, but in the banking sector, we have been reducing exposure to European banks, and that's people. If there's a lot of uncertainty there, you're going to have less investment banking business. People aren't maybe going to be taking loans to start new companies. So Europe is certainly one area that we have been reducing some exposure there. So the bulk of our exposure, as I mentioned before, is in the U.S. We do own some short Japanese banks. We do have some Asian auto manufacturers as well. Those would be some of the high quality shorter duration bonds that I mentioned earlier that for us are going to serve as dry powder that we will sell and put to work when conditions stabilize in terms of the Fed.
What percentage of the bonds you own do you think you hold to maturity, and which ones are you getting out? What's sort of the turnover?
Yeah, so turnover, it can certainly vary. I have to say it's at points in time in the past it had been over 100%. It's probably significantly below that now. But we have core holdings that we'll hold for quite some time. I mean, typically we're not holding bonds to maturity in the portfolio. There's always going to be other opportunities out there. We're relative value investors, so we'll have our thesis, we'll have a price target for a bond, and when it reaches there, we're going to look to sell it. So we're not going to typically. It's very low that we ever hold anything to maturity in the portfolio. This is it's an active total return portfolio.
Right. Okay. And final question, because we are running up here against the clock. Do you offer your strategy in an SMA format?
Yeah, so we do have so this is the UCITS one that we're discussing today, but yeah, we do for larger sizes, we do SMA portfolios. Yes.
Okay. What are those sizes? Just so I can let them.
Typically, starts between 50 and 100 million.
Okay. Understood.
Yeah.
Okay. Great. Well, Dana, thank you so much for your time. We know it's like I joked to start that it had been a quiet week for fixed income, or a quiet start to the year for fixed income investors. Really have not seen anything like this. The combination of fixed income and equity volatility to start a year in quite some time. So we really appreciate you taking the time to talk to us about your investment grade portfolio and some of the considerations behind it. We truly appreciate it.
Thank you for having me.
All right, everyone, take care. We'll see you next week.